just finished, we rounded off the November about three questions in November 2024, tested some of the concepts, explicit and some not explicitly directly on the evaluation and review chapter. Okay, so let's get to May 2024 now and check the questions that were tested. So please confirm. Can somebody confirm you can see my screen, please? Let me don't assume that. Sammy, please confirm. You can confirm. Sammy is used to confirming for me.
I can hear you.
I see your screen.
Thank you, Jay. Thank you. Fantastic. Thank you. All right. So we'll move to May 2024 question 2 and C. 2A and 2C tested, I think, either implicitly or directly, the concepts on evaluation and review, chapter 9. Okay, so we have the statement below in an extract of PPE and the notes to the financial statements of ABC Limited. So we have the cost, maybe an FAR, fixed asset register. We have the depreciation and impairment losses. Then we have the net carrying amount of those impairment assets, or the impaired assets. And we have a statement here stating the above situation was a situation of the SFP of the company when it was signed at the board of directors meeting. During further review to sign off the audit file, it was discovered that the classification of some of the items as impaired were due to wrong classification, and the value have actually increased due to a new road network in the location. This affected the impaired losses for the year. The new value of the buildings affected and shown in the note above as available from market survey had actually grown to 8.5 million naira within the period under review. Okay, so we are asked to, on the A part, evaluate the different types of audit review, the purpose and scope of the review, or the reviews, the different types. Evaluate the different types of audit review, the purpose and the scope of the review. So we have 10 marks for this first question. Number 2, advice on the treatment of the issue raised with regards to wrong classified assets. Okay, so don't forget that this review A part also conflicts or connects to chapter 5, audit approach on ISQM 1, ISQM 2, engagement quality review, and all those kinds of reviews. So these concepts are also interconnected with chapter 5. So if you see some questions in chapter 5 or the concept tested or repeated in chapter 5, is almost the same concepts that could be tested under any of this chapter. Okay, so generally the question tests 2 distinct areas on quality management. The quality management aspect of an audit is part A. Yeah, but it still resonates with review, evaluation and review. And also the of accounting standards, IAS 36 and IAS 16, to correct a mistake, the part C. So generally, my observation on this question is that the part A, which is audit review, is a direct conceptual test of audit quality management, part of audit quality management. And it requires different types of reviews, peer review, engagement quality review, hot review, cold review, and the objective and scope of the review process as mandated by standard like ISQM 1, international standards on quality management. Then the part C, impairment reversal, it's a core accounting issue that is the core accounting issue around an asset wrongly classified as impaired. And the subsequent discovery that the value has increased due to a road network confirms the original impairment was unnecessary. So the required action is the reversal of the wrong recognized impairment loss. So another observation in this question is that the key figure is to be reversed. That is the impairment losses for of specifically land and building as the category affected by the road network. Okay, so the 2 prompts, evaluate, then number 2, advice. All right, so the first prompt on evaluation, what do we write on the 2A part in evaluating different types of audit review? And there's a whooping 10 marks. So what do you write? Clearly define the objective of audit review. That's what to write. List and briefly explain at least 4 types of review and provide the 3 main purposes and scope. So number 1 is to identify, then speak about the purpose and the scope. So how do you write that? Structure your answers with clear headers of for the types of review, their purpose, and their scope. So the types of the review, the purpose of the review, the scope and checklist of the review. Ensure distinct explanation for the 4 review types. So we have peer review, we have engagement,
quality control review.
Yes, quality control review. Thank you. Then we have hot and we have cold review to secure your maximum parts. Thank you, Sabi, for that. And for the C part, on advice on treatment of wrongly classified assets. So what do you write? Just simply state the accounting principle, which is IAS 36, that requires reversal of impairment if the assets recoverable amounts increase. Secondly, you need to identify the error. The original impairment was a misstatement. And number 3, provide the necessary correction or journal entry. So how do you write that? Be direct. State the impairment must be revised, provide the amount and the effect on the financial statements. The market value of the amount is contextual, but not the adjustment amount. So the reversal should correct the error, which is the amounts originally charged. So generally, strategies to earn your marks, you need to structure and segment your answers. So for the A part, use list and headings. You can see the examiner did that. He used numbered list and headings to ensure you cover all 3 aspects required by the question. The 3 aspects in the question is, don't forget the types, the purpose, and the scope. And hit the 8 points required for the main marks. Another strategy is to link accounting to the fact. Link your accounting to the fact, which is for the part C. Explicitly link the road network to the increase in value and the subsequent requirement under IAS 36 to reverse the impairment. Use the right figures for the part C. The key figure in the incorrectly charged impairment loss in the table under land and buildings must be reversed. So let's look at the marking key and let's speak to some of the answers and see. So the marking key now. Yes, please, Grace, go ahead. Your hands are up.
Good evening, sir.
Yeah, good evening. Nice to have you. It's like your phone finally allowed you to come in.
The network is just saying.
Sorry about that. Nice to have you.
Thank you, sir. Talking about correction or the reversal, would I be right to say the journal you're talking about to indicate in my answer that in reversing it, the management are supposed to debit the asset and credit impairments? Will I be right?
Yeah, exactly.
The right treatment.
Exactly. That's the right treatment. Correct. Very correct. You're very right. Yeah, you're welcome. Thank you for that contribution. So you're very correct to say that management should do this, and that's the right entry: debit PPE or building and credit impairment loss. Okay, thank you for that contribution. Okay, so let's share some thoughts on this marking guide and some of these reviews and what they look like. We are asked to advise. Okay, we're asked to evaluate, number 1, the prompt, and number 3, the C part, we are asked to advise. Excuse me. Okay, so in advising or in evaluating, let's start with evaluation, the 2A part. Evaluate the different types of the audit review, the purpose and the scope. The objective of audit review is 2 marks. I think the 2 marks are marked for this. Though it's not explicitly stated. I think it's explicitly stated. Yes, the definition and objective is 2 marks. The review of audit work is a critical control, is a critical quality management measure. If you look at ISQM1, based on what we looked at in the audit approach. So don't forget that the objective of this review is to confirm that audit was performed to the required professional standards. and that sufficient appropriate audit evidence, which should be our general acronym now, we should be used to this hook. Sufficient appropriate audit evidence has been obtained, and that the conclusions reached support the audit opinion to be issued. So that's the objective. That should earn you 2 marks. Then for the types and purposes and scope of the review, which is 8 marks, you earn 1 mark each for 8 points. So let's look at the types of review. Number 1 is peer review. A peer review is a review conducted by another independent firm of chartered accountants, often mandated by professional bodies to assess the firm's overall quality management system. Very simple. A peer review is conducted by another independent firm of chartered accountants. So, for example, Gabriel, Josiah and Co. performed an audit, and there were some issues. The Financial Reporting Council asked Samuel and Co. to go and reperform the audit and check what Gabriel, Josiah and Co. did. That's a peer review. So it's often mandated. It may not be Financial Reporting Council of Nigeria. Gabriel is the chartered account. His firm is under ICANN. Samuel's and Co. chartered accountants are also under ICANN. And ICANN had some issues with Gabriel's audit. Gabriel, Josiah and Co. ICANN can mandate Samuel and Co. to go and review the work Gabriel, Josiah and Co. did. So that's a peer review to assess the firm's overall quality management system. And number 2 is engagement quality control review, or a HOT review. Is a review performed by an experienced partner, not part of the engagement team now, which is currently a requirement under the ISQM standard, and is conducted before the audit report is signed, mostly for listed and public interest entities, focusing on high-risk judgments and the opinion of the engagement team. So that's it about the engagement quality control review, or the HOT review. And the general area around HOT review now, let's separate it from engagement quality review now. The HOT review is actually similar to engagement quality review, but is often implied to maybe non-listed entities or specific engagement where the engagement partner requires a second opinion before signing the audit report. So it's mostly for limited companies, not really listed companies. HOT review, you have that. And this in areas of special engagements where the engagement partner actually requires a second opinion, and that's where we have HOT review. So he wants a second opinion to monitor the work of the new partner. So that's another area to earn 1 point. Then for the monitoring review, which is code review, is a review performed after the audit report has been signed to assess adherence to the firm's quality control policies. Sorry, the firm's, there's nothing like quality control now, quality management policies, procedures, and consistency of application across engagements, audit engagements. So those are the 4 types of review. And let's look at the purpose, scope of each review. The purpose is to obtain sufficient evidence to verify that the work performed and evidence gathered was sufficient and appropriate to support the conclusions reached. That's the purpose. And another purpose is compliance, to ensure that the audit was conducted in compliance with relevant international standards on auditing and also statutory and regulatory requirements. And also another purpose is to confirm consistency, to confirm that the financial statements reflect the application of appropriate and consistent accounting policies in accordance with the applicable reporting framework. And another purpose or scope speaks to resolution on checking that all significant problems encountered during the audit, including misstatements, errors, and judgmental areas, have properly or have been properly resolved and documented. So that's generally the purpose or scope of reviews, pragmatically. Then for the C part, we have, this part is not the B, C part. We didn't put the marking guide for the C part. Okay, I'll have to correct this document. The C part is an advice, so that's 3 marks. It's not much. I went to pick the B part of that question. Okay, the C part is here. Treatment of wrong classification. So please ignore the B part. This is the C part now. So C part, treatment of wrong classification. So the C part asks us to advise on the treatment of the issue raised with regard to the wrong classified assets. The advice must, or your advice must address the reversal of the incorrectly recorded impairment loss. So the first one is you speak around misstatement and the standard. The classification of asset as impaired was an error, since the recoverable amount, which was triggered by the market survey or road network, is higher than the carrying amount. So the original impairment loss recognized for land and building must be reversed in accordance with IAS 36. Then the second point, you need to speak around the required adjustment. Management must make an adjusting journal entry to correct the misstatement. So like Grace said, the entry would be debit accumulated depreciation or impairment losses, or directly debit the property, plant, and equipment account and credit impairment loss reversal, or the income statement, whichever is applicable with the amount. And the third point, or the third thoughts, or you need to submit, is around financial statement impact. This adjustment is actually material and will result in an increase in the net carrying amount of the building, or the land and building, and the corresponding increase in profit for the year. So by reversing the original charged impairment expense. All right. So that's it for that little question on types of review and how to reclassify a wrongly charged asset. Excuse me. Any questions? Any contributions, observation? So we'll run to the next question. Any questions? Okay, if there's none, let's go to the same May 2024, question 3B1 and I think 3B2. And the question is on Moonshine Limited. The question reads, a client's company has prepared draft financial statements for the year to 31st December 2020. In February 2021, a legal claim was made against the company, claiming substantial damages. The company's lawyers have decided that the claim has less than 50% chance of success. If the claim succeeds, the company would have sufficient cash resources to meet the claim in full. The matter is disclosed in the draft financial statements. The matter is disclosed in the draft financial statements in a note as a material contingent liability. Required. Advice if the audit opinion should be unmodified. And if so, should the report contain a material uncertainty related to going concern paragraph? 3 marks. Number 2, discuss the form and content of modified auditor's report. All right, short question, but it has left audit, evaluation and review to reporting, chapter 14. But then it resonates practically with evaluation and review. So when we come to chapter 14, we just cap and solidify our understanding of both reporting and recognizing issues after year end based on the evaluation and review. So take note of that to look at reporting and the form of the content of modified opinion, unmodified opinion, and all that in chapter 14. But then we need to look at it in this chapter because this question practically tests the understanding of both evaluation and review and reporting. Okay, so the question actually tests the application of ISA 705 and 706. When we come to reporting, we'll see those ISAs. And those ISAs, 705 is on modified opinion and 706 is on emphasis of matter paragraphs. Yeah. And it's in conjunction with IAS 10. So we are not out of place to look at this question. IAS 10, don't forget, we just looked at a question on subsequent events and IAS 37 contingent liabilities. And it's specifically focused or is focusing on whether a contingent liability requires a modification or a key communication paragraph. And generally, if you observe this question, you see that it's a core issue. The matter is actually a non-adjusting contingent liability. Why did I say it's a non-adjusting contingent liability? It's made after year end and it has less than chance of success. So management has actually correctly disclosed it in the notes. So the matter is actually a non-adjusting contingent liability because they've disclosed it in the notes. Take note of that. Then for the audit opinion, which is unmodified, since the accounting treatment, speaking to disclosure as a contingent liability, is correct under IAS 37, which the disclosure is probably not going to happen. And under IAS 10 is a non-adjusting event, then there's no material misstatement. So therefore, I think in my opinion and from the examiner's answers, the audit opinion must be unmodified. That's the answer. So the going concern paragraph is inappropriate. The specific fact that the company has sufficient cash resources to meet the claim in full is critical. This removes, I think, any significant doubt regarding the company's ability to continue as a going concern, making a material uncertainty relating to going concern paragraph. I think that statement is unnecessary and inappropriate. So those are my general observations about the question. And let's look at what to and how to write such a question if you choose to do it. So in writing, what do you write? Let's speak first to the opinion. State clearly the opinion should be unmodified. That's established. And number two, justification for that opinion, that unmodified opinion. Excuse me. Explain that the accounting treatment, which is disclosure as a contingent liability, is correct under IAS 10, under IAS 37, because the claim is a non-adjusting event. And talking about what they said is a chance, or its success is less than probable. That means there's less, like the statement the lawyer said, has less chance of success. So that's the justification for your opinion. Number three, what do you write? The going concern paragraph, you need to state clearly that a material uncertainty related to the going concern paragraph is not necessary. And number four, justification for omission. Use the specific scenario fact that the company has sufficient cash to meet the claim, eliminating significant doubt about its going concern status. So how do you write that? Your style and structure should include the use of direct and affirmative statement for the conclusion, talking about the unmodified opinion and the no going concern paragraph area. Then for the structure, in writing, structure the justification for each part separately, for the opinion and for the going concern, to ensure your 3 marks are picked practically for the first part of the question. So the answer on the screen should guide you as you practice in addressing such a question. So generally, strategies for earning your marks. We'll come to ISA 706 and 705 on reporting. But then, before then, you need to be precise about the type of paragraph, which we'll learn. The modification of opinion around qualified, adverse, disclaimer. That one falls under actually ISA 705. And for communication paragraphs like material uncertainty regarding to going concern, speaking to ISA 570 and ISA 706, they are different. So the contingency rule is, remember that IAS 37 rule is that if there is a probable event that is certain, like one question we saw, the question we saw previously, then the provision must be made for a liability. But if there is possible crystallization of that event, there's contingent liability. You only need to disclose. Then if there is a remote issue, then there's no need for disclosure. So the safety value clause around this is that the fact that a client has sufficient cash is the safety value or the safety valve, safety value or safety valve, whichever way you want to look at it, or safety net that prevents the material uncertainty from affecting the going concern assumption. So there's a safety valve or a safety net or a safety value that could cushion the effect of whatever contingency has come to the fore. All right, so let's look at the marking key now. A long answer. Let's look at the marking key and the time, the kinds of points. Okay, so from the marking key, we're required, the first part is the marking guide requires 3 points for the 3 marks in that first aspect and 7 marks. Okay, then 4 marks for the other ones. All right, so the unmodified opinion, we spoke about the audit opinion should be unmodified. This is because the company's disclosure of the legal claim as a contingent liability is appropriate under IAS 37 due to the less than probable or probability of success. The lawyer said that. Then under IAS 10, as a material non-adjusting event, there's actually no material misstatement. So in penning down your thoughts, you need to share practically based on the case scenario. Then for the non-going concern concept, a material uncertainty related to going concern paragraph should not be included in the report. It's not necessary. Then for justification for omission, this type of paragraph is reserved for situations where significant doubt exists about the entity's ability to continue as a going concern. But the lawyers have said there is enough cash to settle that, so there's no issue. So that's the justification for your omission. Since the company has sufficient cash resources to meet the claim in full if it fails, then this situation or this specific legal claim does not cast significant doubt on the going concern assumption. All right, so those are general thoughts on how to end the marks. Do we have any questions? This question. Any questions? Okay. If we don't have any question, let's run. Let's move to question 5, which is...
I didn't get your answer on the B part. Sorry, the Roman figure. Part. Yes, second part, talking about forms and content of modified audit reports.
Yeah, so I didn't share so much thoughts because we'll still be coming to that on reporting. So I don't want us to waste time on reporting. I just wanted us to know if there's an obligation here and if there's a going concern issue. But actually the solution is there. I didn't want to touch too much on the B or the second aspect on IAS 705. We've not looked at that on reporting. So there's a lot of information there. So you read through when I provide this material. Before we get to chapter 14, then we'll be able to solidify that. We'll still repeat this question in chapter 14 so that we can understand the chapter 9 aspect and also understand the chapter 14 aspect on the opinions around this. So that's why I didn't really go into it in detail.
All right, noted, sir.
All right, thank you for that question. Okay, so let's look at question 5, May 2023. He didn't test anything on this on chapter 9 in November 2023. So take note of that. That's why we are moving from May 2024. The last question was May 2024. On November 2023, he didn't test any concept impliedly or explicitly or directly on chapter 9 evaluation and review. Okay, so let's look at this question. Question 5, Vigor Microfinance Bank. The question reads, Vigor Microfinance Bank was incorporated on July 1st, 2024 as a public limited liability company under the CAMA. The bank obtained Microfinance banking license from the central bank on August 5th, 2015 to operate on a nationwide basis and commence banking operations on September 5th, 2015. The bank's principal business is to provide microfinance banking and related services to the poor and unserved segment of the society with a view to alleviating poverty under the Microfinance Institution Ordinance. In 2019, the bank decided to convert to a commercial bank and commence business operation on August 10th, 2019, after final approval from the regulator. As of December 31st, 2019, the bank had 5 branches in 2016-24 at the Federal Capital and other 4 major geopolitical zones in the country. With the new commercial banking license, the bank employed the services of F&K George Principal Services to audit its financial statements. As part of the activities to be carried out on the initial engagement, the external auditors began a review of the books of account of the predecessor auditor, and the following issues emanated among others. Number 1, some PPE in the books of account and in prior year financial statement had negative carrying amounts. Number 2, the basis of impairment included the prior year financial statements regarding loans and advances could not be established from the working papers. Number 3, there was a material amount of pre-operating expenses that was included in receivables schedule, of which could not be satisfactorily provided. Number 4, the audit work performed on interest income in the prior year was not supported by sufficient appropriate evidence. Number 5, details of outstanding tax liabilities could not be provided, as the amount in the financial statements was the figure supplied to the external auditor by the tax consultant. It was discovered that the figures were not subject to review by the former external auditor. There was no satisfactory explanation on nil balances included in prior year financial statements on contingent liabilities, as there were no evidence that request for confirmation was made from all solicitors of the bank, and the details of contraventions included in the examiner's report were not considered for disclosures in the financial statements. CBN is requesting for the financial statements of the bank, and management is worried that there is a delay in the release of financial statements by the new external auditors, despite several notifications and reminders. The CFO of the bank complained to you as a member of the engagement team about the delay in concluding the audit. He could not see the reason why your firm should be concerned about prior year financial statements issues, when your firm was not the one that expressed opinion on it. Added to this, responsibility of the financial statements rests on the board of directors. Required, discuss why your firm needs to carry out the above exercise. B, analyze the nature and extent of audit procedures necessary to obtain sufficient appropriate audit evidence. C, evaluate what your firm might likely do in case of inability to obtain sufficient appropriate evidence from this exercise. Okay, we looked at this question actually in Audit Evidence, Chapter 8. And I know somebody will be wondering why we are looking at it again in Evaluation and Review. All right, so that's because there are prior year balances, and prior year balances need to be reviewed critically. It's actually a critical conceptual question centered around ISA 510, initial audit engagement and opening balances. That's why we have to relook at the question in the context of Chapter 9, Audit and Review. So the transition of this bank to a commercial bank and identifying issues around the predecessor's file significantly raised the question for the new auditor. So the general observations, or my general observations around this question, is that it tests our ability to understand the auditor's responsibility around initial engagements, ISA 510. The CFO's complaint is directly addressed by the requirements of this standard. The prior period closing balance, which is very important for review and evaluation. And the prior period closing balance must be the current period's opening balance, and it must be reliable. Don't forget that. And the risk context around the numerous issues identified, negative PPE, loan, lack of loan impairment basis, undocumented tax liability, indicate extremely high control risk and the possibility of pervasive material misstatements carried forward into the current year. So you are actually supposed to structure your answers on the requirement around demanding why, which is part A, then how, part B, and the consequences, part C of ISA 510's procedure based on the chapter on evaluation and review. So don't forget, part A speaks to why, part B, how, and part C, the consequences of ISA 510's procedure. So what do you write? How do you write? And the question, part 5A, you need to discuss, the prompt is to discuss why your firm. So discuss is the prompt. So in discussing, you need to state the three main objectives of reviewing opening balances as per ISA 510. And we need to focus on the continuity of financial statements. That's what to write. How do you write it? Frame the answer around consistency, correctness, and classification. We used some acronyms in those lecture notes to help us remember. Consistency, correctness, and classification. That's how you write it as the basis for the current period's audit. So use professional terminologies like correctly brought forward and consistent applications of policies, something like that. Then for the 5B, the prompt is analyze the nature, okay? But to analyze the nature. So for the 5B, what do you write? You need to provide at least 4 comprehensive. It's an 8-mark question, so it's much. The A part is how many marks? Okay, 3 marks. So this 8 marks, the weight is heavy, so you need to provide at least 4 comprehensive audit procedures required by ISA 510, focusing on how evidence for the opening balances can be obtained. For example, relying on the predecessor's work, current previous testing, and direct testing. So that's what you write. And how do you write it? Since 2 marks are given per point, ensure each point is detailed because it's 8 marks. Mention specific compensatory procedures required by the scenarios facts, like reperforming loan impairments, and that's performing loan repayments. That's the second issue, I think. Yes, issue number 2. So we should discuss around that, the loan impairments. Reperforming loan impairments, the second issue, or confirming tax liabilities. I think that's number 4. Yes. Tax liability, sorry, number 5. So you need to discuss around mentioning specific compensatory procedures required by the case facts, like reperforming loan impairments and confirming tax liabilities. Okay, then for the C part, where's the C aspect? So for the C part, you need to evaluate what the firm might likely do in case of inability to obtain sufficient appropriate evidence. So that's a formal question. What do you write? You need to detail the actions required when a scope limitation arises, covering the internal consultation and the external reporting consequences. So how do you write that? Clearly distinguish between the 2 outcomes for a modified opinion based on the severity of the scope limitation. Then for a qualified opinion, that's actually material but not pervasive. But for a disclaimer of opinion, is material and pervasive. We'll look at that in detail when we come to reporting. So generally, you need to strategize around answering such a question in the sense that the ISA 510 link is pivotal to evaluation and review. So always start by framing the discussion within the context of ISA 510 requirements, especially when refuting the CFO's argument that you are not the one that carried out the last audit. So ISA 510 will clarify that his insinuation or his argument. And also address specific issues for the Part B. General procedures are good, but mentioning procedures that address the listed issues from number 1 to 8 is better. For example, using current cash receipts to test operating receivables, which provides sufficient appropriate evidence on the existence of the opening balance, is a good way to address the question. And also reporting precision based on Part C. When discussing the modified opinion, explicitly try to use the ISA 705, 706 terminology: scope limitation, materiality, pervasiveness but not material, material but not pervasive. All these statements, we'll get to juxtapose that when we come to reporting, so you can understand the link between chapter 9 and chapter 14. So let's look at specific guides on picking those marks. So for the A part, the 5A question on discussion for reasons or reasons, we have 1 mark for each. So the first thing you need to talk about is the correct carried forward balance. And the carried forward balance is to ensure that the prior year's closing balance has been correctly brought forward to the current period as the opening balance, or that any necessary restatements have been properly applied. Those are the reasons. Secondly, the policy consistency we spoke about, to verify that the accounting policies reflected in the opening balance have been consistently applied in the current period, or that any changes have appropriately been accounted for and disclosed. And thirdly, the misstatement impact. You need to obtain sufficient appropriate evidence that the opening balances do not contain misstatements that materially affect the current period's financial statement. So these are the reasons, actually, and you need to discuss to get the 3 points around this. Then for the 8 marks, quite some weight, so speaking to the analysis of procedures. You have 2 marks for any 4 points you provide. So number 1 is to review the predecessor's audit working paper. The predecessor auditor You need to review his working papers and obtain management's permission to review his papers to understand the procedures performed and the evidence obtained on the balances, especially high-risk areas like loans, interest, income, and taxes. You see those issues in the fourth, and the fifth area in the question. So reviewing audit working papers is the first. Then the second, discussion around current period procedures on opening balances. Need to perform specific audit procedures to obtain evidence on opening balances through current periods transactions. For example, vouching, subsequent cash receipts to confirm. You need to vouch subsequent cash receipts to confirm the existence and ultimate recoverability of opening trade receivables, which is the third issue in the case. And thirdly, you need to directly perform substantive testing, direct substantive testing. So where the prior audit evidence is insufficient, you need to, so for example, that tax and the loan impairment, the auditor must perform direct substantive procedure. We'll talk about that in the classes on the opening balances themselves. And this could include independent confirmation of outstanding tax liabilities based on the number 50 issue on the case, or recalculating and reviewing the basis for the loan impairment provision based on the second issue. And the fourth point you could provide is to review consistency of accounting policies. Systematically check that policies used for complex accounts, for example, PPE depreciation, revenue recognition for interest income, capitalization of pre-operating expenses, have been applied consistently. So you need to review consistency of application of accounting policies, and that any prior material misstatements identified, like the negative PPE, have been corrected in the current opening balances. Then you could add another buffer point around communication of misstatements. So if procedures reveal that opening balances contain misstatements that materially affect the current financial statements, the auditor must communicate this to management and those charged with governance and insist on the necessary amendments or restatements. Very, very key. So for the last question, we have the C part, we have just 4 marks. So could provide 2 marks each for any 2 points. You could provide 2 points each for the 2 marks or the 4 marks. That's 2 points, 2 marks for each 2 points. 2 times 2 is 4. So the first area you could discuss is with those charged with governance and legal review. The firm must immediately discuss the matter with management and those charged with governance. That's the first thing you should do, and explain that the implications of the scope limitation. If resolution is possible, the firm should seek legal counsel regarding their reporting obligations and the possibility of resigning if permitted by law or obligation when those charged with governance refuse to restate those findings. Then for the issuance of the modified audit opinion, if the sufficient appropriate audit evidence cannot be obtained and the required restatements are not made, then the auditor must issue a modified opinion due to a limitation on scope of the audit based on ISA 705. Speaking to if the effect is material but not pervasive, a qualified opinion should be issued. But if the effect is material and pervasive to the financial statements, especially relevant in a bank's context with systemic risks in loans and deposits, then a disclaimer of opinion is actually what the auditor should issue. Okay, so that's it on this full question that tests audit evidence and part of evaluation and review. Any question? Our time has been fastly spent. We have just a few minutes to close. Okay, so if we don't have any questions, let's look at this last question, then we'll shut down before we come back for group audits. Let's look at this last question, then we'll shut down. This question is on November 2021. So we'll look at, the question reads, your firm is the auditor of Sharp Electronics PLC and PLC, a listed company, which assembles electronic home appliances for sale on retail and wholesale basis. The electronic appliances parts are purchased from within and outside the country. The extract of the SFP is as follows. So we have 2019, about 479 million. 2018, 456.7 million. Okay, that's for non-current. Yes, that's correct. Total assets. And we also have total equity and liabilities, 497.1, 456.7. Okay, so you've been asked by the partner in charge of the audit to consider your firm's audit responsibilities with respect to subsequent events and the associated audit on such matters. So A, discuss the responsibilities of the auditors for detecting misstatements in the financial statements during the following periods. Number one, from the end of the reporting date and up to the date of the audit report, 8 marks. Number two, after the date of the audit report and before financial statements are issued, number 6. 6 marks. Number three, after the financial statements have been issued, 3 marks. Then B, state the details of the work you carry out in period A to above to confirm that no adjustments are required in the financial statement. So period A to above is after the date of the audit report and before the financial statements were issued. This is an explicit test of the reporting dates we looked at based on IAS 10, events after reporting date. Wow, it's a 20-mark question. All right, so ladies and gentlemen, I think this will be the last question for this evaluation and review. We'll look at the others by ourselves. So it's actually a comprehensive test of our responsibilities as auditors for subsequent events. And that's defined especially under ISA 560. And it's segmented by the critical time periods of the audit process. So the time periods before, after, and all that. So I observe that the core standard to guide us in this question is ISA 560, which divides the auditor's responsibility into 3 distinct phases relative to the auditor or the audit report date and the financial statement issuance date. Another observation is the active and the passive responsibility. What does that mean? The active and the passive responsibility speaks to a key distinction to make for the auditor to make on the active search for subsequent periods. So period A1, if you look at the question, you see that period A1 vice is active, while the passive responsibility to act only if the facts became known is for period A2 and period A3. So actively there is period A1, subsequent events, and period A2 and 3, which is passive based on the examiner's prompt. So the scenario, actually, the purpose is the provided financial extract and the context, which is a listed company into electronics assembly, primarily serves as a background to establish a high-risk environment where subsequent events like inventory obsolescence, impairment of receivables, and asset destruction are actually highly relevant. So, in speaking to question A1, what do we write and how do we write it? We are asked to ask us to discuss. Okay. So we are asked to discuss. And in discussing the responsibilities of the auditor, this part requires a direct discussion of the auditor's duties in each period. So for A1, the end of the reporting period to audit date is actually a whopping 8 marks. So these 8 marks, you need to concentrate on that. This is the period of active responsibility. That's the end of the reporting period to audit report date is actually active responsibility for the auditor. So what do you write? State the overall objective. State the overall objective. And what's the objective is to obtain sufficient appropriate evidence that all adjusting and non-adjusting events are identified and reported. You need to detail the 2 categories of the procedures. Number 1, the procedures performed during the normal audit work. So procedures performed, during normal audit work like testing receivables, inventory are valued at cost and net realizable value. Remember, we spoke about that. Secondly, procedures around aiming to specifically identify subsequent events. And those procedures could include reading minutes of meetings, inquiries of management, and getting management's representation. Then how do you write that? You need to like you can see on the screen, you need to use bulleted list to provide your submissions with two distinctions, talking about the normal audit work and specific procedures. These are directly in the slides, in the study text we looked at during the classes. This is to ensure to ensure that the required 8 points are clearly identifiable. Very key. So from the right up, I think you have more than 8 submissions here. Yes, for A1. So please read through that to be able to practice how you answer such questions. So for the A2 part, okay, so for the A2 part, after the audit report date and before issuance, that one is 6 marks. This is actually a passive period because the audit report date and before issuance, what do you write in such a scenario? You need to state that there is no obligations to actively search. Yeah, and you need to detail the 3 steps the auditor must take if a material fact becomes known. What will he do? Number 1 is to discuss with those charged with governance, determine amendment if it's necessary, then inquire on the plan to perform the amendment. So those are the 3 things you do. And also you need to detail the auditor's recourse if management refuses to amend. If management refuses to amend, then he has to modify the opinion if it's not issued, or prevent reliance on that opinion if it has been issued by cascading to shareholders in their meetings. We spoke about that in the classes. But don't forget that. So how do you write that? Clearly state that the no active search rule first applies to this second part. Then structure the response using the action steps, which is first to discuss with management, determine if there's amendment, and inquire for the plan to amend, and the potential consequences of management either doing or not doing. And if they refuse to do it, you need to modify the opinion. And if you've issued the report, you need to prevent reliance on that report by cascading it or calling management's attention to it. Very, very key. So that's for the second aspect. Then for the third aspect, fact discovered after the financial statements have been issued, is 3 marks. So this is the minimal reporting period. So what do you write? State there is no obligation. If a fact becomes known, the initial steps are the same as the second aspect we looked at, the A2 part, talking about discussing with management, determining if there's an amendment, and inquiring on the plan. The key unique step here is reviewing management steps to inform third parties of the previously issued misleading financial statements. So that's the key step in this third part. So how do you write that? Focus on the unique final steps. You need to ensure public notification and issuing a new audit report with an emphasis or an order matter paragraph on that audit report, on what has correctly emerged. This is very, very important. Okay, so for the B part, state the details of work you carry out in period period A2 above to confirm that no adjustments are required on the financial statements. Okay, so for this B part, it's 3 marks. What do you write? You need to state the procedures to confirm that non-adjusting events are properly disclosed. And this is IAS 10's requirement. So how do you write that? Focus your answer on the disclosure requirements for material non-adjusting events as defined in IAS 10. So the 3 required points are the 2 items that must be disclosed and the specific type of event. Okay, so let's look at the marking key as we round off this session. Right, so specific guidance on the marking key now for question 4A1 is how many marks now? 8 marks. The required 8 points should cover both general and specific procedures. So in penning down your thoughts, number 1, you should write around the overall objective. And the objective of ISA 570 speaks to obtaining sufficient appropriate evidence that all events requiring adjustment or disclosure are identifiable or identified and suitably reflected in the financial statement. That's generally the objective. And secondly, around receivables collectability. We need to provide thoughts around reviewing post-year-end cash receipts to assess the recoverability, around valuation of year-end trade payables, or trade receivables, I beg your pardon. Then for inventory, net realizable values, you need to review post-end sales prices or market data to assess the net realizable value of inventory, talking about valuation of inventory. And the fourth point, you need to discuss around search for liabilities. You need to review post-year-end payments invoice to ensure that liabilities that existed at the year-end, talking about completeness, have been recorded. We could also talk about a buffer point around management's procedures. You need to obtain an understanding of management's procedures established to identify subsequent events. Also, you need to inquire of management and those charged with governance as to whether any subsequent events have occurred which might affect the financial statements. And you need to review minutes, read minutes of meetings, board meetings, committee meetings, management meetings, shareholders meetings held after the reporting date to check if you could pick any events after reporting date. And finally, obtain written representation. You need to obtain written representation from management about whether all subsequent events have been adjusted or have been disclosed. So that's for the 4A, one part on the end of reporting period to audit report date thoughts to end the 8 marks. Then for the... Yes, please. Somebody trying to interject? Okay. That was a mistake. All right. So for the question 4E, two-part, after the audit report date and before issuance, which is 6 marks. The required 6 points. You need to detail your response around the newly discovered fact. So, we spoke about the active and the passive responsibility. So around the passive responsibility, the auditor has no obligation to perform additional audit procedures, or he is not obliged to actively search for events during this period. Then around the discussion, if a fact becomes known, the auditor must discuss the matter with those charged with governance and management. And another point around this second area is to discuss or determine the amendment or adjustment. The auditor must determine whether the financial statements need amendment. That is, whether the facts to a condition existed at the year end. He needs to determine that. Then he needs to inquire on the plan. How does management intend to address the matter in the financial statements, whether it's amendment or disclosure? He needs to inquire of those charged with governance on that plan. Then any refusal to amend, if there is a pre-release, they've not released the financial statement. If management refuses to amend the financial statement and the report has not been released, the auditor should modify the opinion, either qualify it an adverse opinion. Then for refusal to issue, if management has the report or management has they've gotten the audit signature and they have the report and have refused to amend the statements, then the auditor must instruct management not to issue the financial statements. And if they do, he needs to take legal action or get legal advice if they proceed on what to do subsequently. So that's what to say or what to write in any of those 6 marks. Then for the 4A, third aspect, after financial statements have been issued, which is 3 marks. For the required 3 points, you need to focus on post-release action after the financial statements have been released. The first thing is the auditor has no obligation to search to perform any auditor procedure after the financial statements have been issued. Secondly, around post-issuance actions, if a material fact becomes known after that, the auditor must perform the steps of discussion first with management, determination of amendment or adjustment, and inquire into management's plan to perform those adjustments. Then he needs to review notification around if management amends the financial statements, then all good. The auditor must review the steps taken by management to ensure that anyone in receipt of the previously issued financial statements is informed of the amendments or the situation and the reissue of another audit report. So those are the general thoughts to pick for the third the solution to the 4A third part. And for the B part, it's 3 marks. And to pick the 3 points, related to the necessary disclosure of material non-adjusting events based on IAS 10. IAS 10's disclosure requirements on adjusting events must not be adjusted in the financial statements. That's the requirement, but must be disclosed. So for non-adjusting events, disclosure in the notes, if those items are material, are very important. Secondly, the nature of the event. The disclosure must include details of the nature of the event that has occurred. So, for example, destruction of a main assembly plant by fire, it has to be disclosed. Then any financial effect should be disclosed also. Financial effects, which includes an estimate of its financial effect, for example, estimated replacement that cost millions, or a statement that such an estimate cannot be made, something like that. So the financial effect should be stated, and that's how to pick your 3 marks on this last question. All right, so I've taken almost 10 minutes of our time. Do you have any questions? So we could stop here.